So let's talk about this recession that Jerome Powell is going to cause with the Fed, and it's going to be brutal, guys. And especially for my family on SSI, Social Security, SSI, SSDI, fixed income folks, middle class, low income Americans. If you don't have assets right now, it's going to be painful, especially if you don't have assets. Now, they did a 0.5 point rate hike with their last meeting, and Jerome Powell says that they're not stopping right there. This is going to cause even more pain. It's going to cause massive damage to our financial situation. I'm talking about your credit cards, your mortgage, your car loans. Everything's going to be going up. And inflation isn't going away either. Now, the last inflation report may have shown that it was slowing down just a little bit, but the prices are still going up. And it's just that, they're not going up as fast like we had seen previously in the peak of inflation back in June. But all this is doing a major number on stocks and our markets. What can I say, guys? The recession is going to be brutal for non-wealthy Americans. You know what I'm saying? Drop a quick amen in the comments down below if you understand where I'm coming from. I mean, they don't even factor in the cost of food in the core inflation that the Fed issues. It's like they don't even care. That is definitely nonsense for the people who are living in areas where food costs have skyrocketed. Families living on SNAP benefits, EBT, PEBT food stamps as well. No way that Social Security benefits and SNAP benefits could even begin to keep up with the rise in the cost of food. I mean, am I right? Now, the Fed did their last rate hike meeting and they decided to raise the interest rate by 0.5%. Now, it was definitely a hawkish announcement in general, and the stock market didn't react too well. More on that later. But really, from the whole meeting and the post announcement, the most exciting part was the Q&A. We'll pick up on that part a little bit later in this video as well. But first, some general information from the Jerome Powell announcement. So Jerome Powell, he's the head of the Federal Reserve, and he made this rate hike announcement in his prepared remarks. Bottom line, they want to stress just how committed they are to slowing down the economy and basically raising unemployment and laying off regular Americans. Well, who do you think he's coming after when he's doing this? And like I said, guys, they're not done yet. The current inflation rate sitting at 7.1%, and this is still really far off from the Fed's 2% inflation target. So what I mean by this is there is still a lot more pain to come for Americans. Earlier, I talked about inflation and how it's still going up, and it's not going to go up as fast as it was before. I mean, same thing with those interest rates. They're just not going up as fast as they were. In the first 4 meetings before the last one, the Fed raised interest rates by 0.75 percentage points each time that they met. And you saw how the markets reacted. Stocks are down to new lows. The housing market is no longer booming. Company after company announced massive layoffs. Now, they just raised interest rates by 0.5%. At the end of the day, they're still seeing high interest rates for credit cards, for mortgages, and that will further damage our economy. And look out for the next one that's coming. They're probably going to be raising rates again. Then, the one after that. The Fed policymakers are forecasting that their key short-term interest rate will reach a range of 5% to 5.25% by the end of 2023. And so this suggests that the Fed is poised to raise its interest rates again by an additional 0.75 of a point and leave it there through next year. But here's Jerome Powell talking about where they are policy-wise.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy has accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP again for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
So basically, Powell is saying that they're not where they want to be yet when it comes to the economy. Now, what I really want you guys to know about the meeting is that Jerome Powell is emphasizing how much the economy is going to have to weaken further going into 2023. Now, this is very concerning. Now, he pointed out that the full effects of tightening of monetary policy are yet to be felt. And we talked about this before. In fact, the Federal Reserve is expecting a very sharp pullback in growth and that the unemployment rate will rise to 4.6% at the end of the year. We're currently sitting at 3.7% right now in terms of unemployment rate. So that means a whole lot of layoffs that are inbound for Americans. One estimate said that about 1.6 million jobs will be lost. Now, I hope you guys are prepared financially with an emergency fund. And if not, I certainly plan to be sharing more information on how you can get unemployment monthly payments, weekly payments in the event that you happen to be laid off or fired. Well, technically, if you get fired, usually you won't get approved for those unemployment benefits. But those who are being laid off generally will receive severance packages, unemployment benefits, and the like. You see, the way it works is that the Fed's latest increase, its 7th rate hike this year, by the way, it'll make even costlier for consumers and businesses to borrow for homes, for automobile loans, car loans, and other purchases. Obviously, credit cards as well. Now, if on the other hand, you have money to save, you'll earn a little bit more interest on it. Basically, banks are paying more interest because Fed Chair Jerome Powell raised interest rates, and you're seeing higher and higher interest rates being paid out to some of your high yield savings accounts. And if you're looking for one of the highest high yield savings accounts that are out there, I actually found one and I dropped a link for you guys in the description down below. Also, while you guys are down there, make sure to get your free home warranty quote. The link is also in the description down below. It only takes about 15-20 minutes. But really, guys, it's the headline here that anyone borrowing money to purchase large homes or any other kind of large purchase, whether it's a large appliance, maybe a car, they will take a hit. Now, as Moody's Analytics points out, quote, the new rate hike pretty dramatically increases your monthly payments and your cost. It also affects consumers who have a lot of credit card debt. They will get hit right away. End quote. So even before the Fed's latest move, credit card borrowing rates had reached their highest level since 1996. And these are probably going to continue rising in the next credit card statements. So check your mail, guys. Americans are definitely feeling it. Total credit card balances have topped a record high of $900 billion. A survey from Morning Consult confirmed that more Americans are spending down the savings that they accumulated during the pandemic and are using credit cards instead. So eventually, rising credit card rates, interest rates, they could make it harder for those households to ultimately pay off their debts. Now, for people who have home equity lines of credit or other variable interest debt, rates will increase by roughly the same amount as the Fed hike, usually within 1 or 2 billing cycles. That's because those rates are based in part on banks' prime rate, which follows the Fed's. Now, as for savers, high yield savings accounts and certificates of deposits, also known as CDs, they're at a high that they haven't seen since 2009, which means that households may want to boost their savings if at all possible. Get some of that free money. You can also now earn more on bonds and other fixed income investments. Online savings banks usually offer higher yields, so you may want to check those out. Now, looking at the real estate market, mortgage buyer Freddie Mac recently reported that the average rate on the benchmark 30-year mortgage, it dipped to 6.33%. So what this means is that the rate of a typical mortgage loan is still about twice as expensive as it was about a year ago. Now, if you can afford a house right now, if you can afford a home purchase right now, then you're likely to have more options than any time you've had in the past year in terms of what's available in inventory. But then again, those payments, they're going to be bigger. Now, if you want to buy a car payments are up by an average of $61. Average car payment right now here in America is $718 a month. The average payment for used vehicles is up $22 per month, sitting at $565 a month. Financing the average new vehicle with a price of $47,000, it'll now cost you $8,436 in interest. Now, as the car market experts said, quote, they're taking away the buying power so that you can't buy a vehicle anymore. There are going to be fewer people that can afford it, end quote. And this is why we always say fixed income, low income, Social Security, SSI, SSDI. The middle class is going to get hit the hardest in this economy, in this new economy, in the Fed's economy. And of course, then there's crypto, right? Now, I always get asked about it. Cryptocurrencies like Bitcoin have dropped in value ever since the Fed began raising interest rates. So have many previously high value technology stocks. Higher rates means that safe assets like treasuries have become more attractive to investors because the yields have increased. This makes risky assets like technology stocks and cryptocurrencies a lot less attractive. And then there's the recent news of the 3 major crypto firms that are going under. Most recently, the high-profile FTX exchange. Now, this doesn't do a whole heck of a lot for confidence in terms of crypto investors. You guys know what I'm saying, right? Entrepreneurs are frightened and they're pulling out of the cryptocurrency market. But really, guys, it would be smart to prepare for the worst in the stock market, plus some major layoffs in 2023, not to mention tons and tons of entrepreneurial landlords looking to raise rent payments going into 2023. Now, as Jerome Powell said himself, quote, I just don't think that anyone knows whether we're going to have a recession or not. I wish there were a completely painless way to restore price stability. There isn't, end quote. Shouldn't they know it, being the Federal Reserve? Some Fed officials have pointed to some evidence of progress to their 2% annual target. The national average for a gallon of gasoline, for example, it tumbled from $5 in June to $3.21. Many supply chains are no longer clogged, thereby reducing goods prices. The better than expected inflation data showed that the prices of used cars, furniture, and toys, they all declined. So did the cost of services from hotels and airfares for car rentals. Rental and home prices are falling, though we haven't seen those declines feed into the government's data yet. And one measure that the Fed tracks very, very closely, core prices, which exclude volatile food and energy costs for a clearer snapshot of underlying inflation, rose only slightly for a second straight month. Many economists think that the Fed will shift things down to a quarter-point rate hike when it meets early next year. Asked about that, Powell said that he has yet to decide how large he thinks that he should do the next hike. He said that they should, quote, think the appropriate thing to do right now is to move at a slower pace. That will allow us to feel our way, end quote. So here are the Wall Street pros breaking things down for us.
The market is clearly underestimating how high we're going to have to raise rates to cut inflation. That scared the heck out of everybody in Europe, and the yields on European bonds began to spike. Now, we already had weak economic data here. We were softer. That led to these lows, that spike in European rates.
The reaction we just saw in the last couple of days is both technical, but also exacerbated by the Fed's hawkish stance, at least on paper so far.
It's really important for investors not to get lost in the Fed sauce at this point and to really stay focused on how every market reset presents basically a corridor of new investing opportunity if you engage the market with a capitalist mindset.
It looks like the consensus is saying that investors shouldn't expect the Federal Reserve to go easy on the economy because the market is suffering. Here's a quote that I got. Investors have to learn that the Fed is not your friend. It is not your pal. If anything, it's your enemy, at least until Chair Jay Powell finally beats inflation, end quote. Stocks fell after fresh data showed retail sales fell more than expected. Also dragging down the market were hawkish comments from the Federal Reserve. As they said here, quote, Powell could not have been more clear that he's not just trying to stabilize prices at these levels. He wants to roll back the price increases from the last couple of years, end quote. Wow. Now this makes things even more likely that we may see a major drop in the 20% range in the stock market next year. Like they said here, quote, while Jerome Powell's not explicitly trying to send stocks lower, he's certainly not going to shed any tears over it. If anything, lower stock prices are a win for the Fed, end quote. Definitely something to consider, you guys. Really, the key to financial freedom is saving. It's earning money and it's investing. Now, if you have the capital to invest in the stock market and real estate, all that much better for you. And if you're not there yet, you can add to your income streams via a side hustle or even a small business. Now, right here, you guys, if you guys have any questions for me, just let me know if you need any help understanding any of this, and give this video a like if you're tired of the government taking it out on working class Americans. Better yet, go ahead and share this video with your friends and your loved ones who can appreciate this information. Just go ahead and hit the share button right there, guys. More to come in the next one, but for now, this is our big money update and daily news report. The brutal Powell recession that's coming for our stocks, our jobs, and our wallets. Predictions of where the Fed's going in 2023 and how you should prepare for crap to hit the fan, even if you're on fixed income, Social Security, SSDI. And as always, I want to thank you guys so much for watching the video. Appreciate you guys dropping a like for the video. And I look forward to seeing you guys on the next one. Y'all stay blessed and be safe.